number 19 of our Travel Trader series, and I want to talk to you today about something which is called the ATR. ATR is short and stands for average true range, or how I would call it, the average trading range, so it gets sticky in your head what we are talking about. And it's directly related to volatility we talked about yesterday. So yesterday we said if you have these huge, big candles, obviously we have a bigger volatility in the market right now than if you have very small candles, something like this. So how do we use that? Well, first of all, the ATR gives us a number, and before we talk about the average true range, let's talk about the true range first. When you recall what we said about the line charts, we have one price, a closing price each day, and we want to have more information. That's why we refer to open, high, low, close data. Now we have a trading range between, let's make it a cream candle. We are very positive here, so we always want things to go up. Unless they go down and we already know about it, we'll make money anyway, but here we stick with a cream candle. So the opening will be at the bottom and the close will be above. Now that is one range between opening and closing, but it's not the real trading range, because obviously we went lower during the day and we went higher as well. So for us, the true range, or TR, would be the high of the day minus the low of the day, and that's a certain number. Let's say in your market it's 10 points on that day. Now we want to know about the average trading range, so we have a look at what happened in the past, and usually most people use an ATR of the last 14 periods, which could be minutes, half an hour, hour, days, weeks, months, whatever you're trading, whatever fits your strategy. The ATR gives you different options, but most people look at the last 14 periods. Of course, you can also look at the last 10 periods, 12, depending on what you're trading, which market you're trading, also on how many days is your market open. That might vary a little bit. Here it all comes down to research, what works best. As we said, we want to use that for minimizing our risk, and we always minimize our risk by using something that we will call a stop loss. What we want to make sure is that if you're in a market that now has a high volatility, that we don't enter the market, and because of the prices going up and down naturally within a day, that we get kicked out and are out of the trade with a loss. And then we look at the trade like a week later and think, that did exactly what I expected to do. So it exactly went up as I thought it would, but because my stop loss was somewhere here in a spike during the day or during an hour, whatever your time frame you're trading, you got kicked out. So we want to avoid that, and in order to avoid that, we have to account for the current volatility that we have in these markets. And we do so by having a look at the average volatility. If the volatility over the last 14 days or 14 hours, 14 minutes, whatever it is, was high, we will have a stop loss here where we say, okay, we are ATR away from our entry price. So we are away from our, let's call it entry price, or EP, to shorten it up. And now, how big does that ATR need to be? And the answer is, surely it needs to be bigger than 1, because if you are less than the natural volatility during that day away from it, chances are that you will get stopped out within the day with a loss and the market runs away from you. So the number here certainly needs to be bigger than 1. And then it all comes down to research again, depending on your market and what you do. It could be 1, 1 point something, 1.2, 1.5, 1.8, 2, even up to 3. So let's say somewhere between 1 and 3 would be a sweet spot. So you give the trade a little bit of wiggle room, so you don't get stopped out within a day. So it can unfold a little bit, it can drop a little bit, it can go a day against you. But if a stock or a market, a commodity, a forex pair or something goes against you for, let's say, 3 days and you're in swing trading, probably you entered the swing either at the wrong time, so something's wrong with your timing or your timing indication, or something's wrong with the trade. Let's say the market turns and then it will go down anyway. So something's at least wrong, and you don't want to find out after a week of dropping down that it was a bad idea. You want to get out with a minimum of risk, because in trading it's all about risk management. So that's the ATR. It gives you a number. So the average number of the last X periods, whatever X is for you, and you multiply that with the number with something between 1 and 3. Depends on what you're trading. We will talk about different strategies and we will have different ATRs for that. However, you want to be that amount, that number of points away from your entry price in order to make sure that the trade has enough room to unfold. And then it all comes down to trade management, because this only helps you how to minimize your risk. Now, we still don't know how do we get the money, when do we exit it, how far will it go, how far should it go, and then will we take the money out, or do we let it run endlessly or whatsoever. These are things that we will talk about when we talk about the topic of trade management, which is something we will do at one of the coming weekends. Thank you very much for watching. If you have a specific question to the ATR or the volatility, stop losses and how it's all related, please let me know in the comments below. If you have any other question or any suggestions, always happy to talk to you. And thank you for watching today. And I'm looking forward to talk to you again tomorrow, Monday. Stock market is opened, not in the US. I think it's Martin Luther King Day, so they have holiday, bank holiday. So some of the markets, CFD markets and stuff like that, will be open, but officially the stock market is closed. However, we can trade a lot in Europe, Australia, South Africa, different other countries. So we will have a lot of fun tomorrow trading again, and I'm looking forward to talk to you about that. So thank you very much for watching, and I'll see you again tomorrow.